of rotation the other way in the next few months. So if I think about bond markets as one of the key drivers of sector rotation, bonds to us and across the yield curve, rates are too high now. Bonds have sold off too hard. Bond yields, I think, are going to have a phase of moving low. And we've seen that price action start to play out in the last few days. We've had some quite dramatic moves in 2-year bond yields and 10-year bond yields over in the States and in Europe, as you've been reporting over the last few days. And I think that shows us a couple of things. One, it shows us that short bonds is a very crowded trade. The positioning is aggressively short. Everyone's got that trade on, and actually that's why you're getting sharp moves the other way. And two, what it's really telling us is there's a bit of a soft patch in the global economy. ISM services yesterday was a good illustration of that. US housing softening, some of the industrial side softening. There's been a big build in inventory. So I think bond yields should come off, and that should drive a sector rotation temporarily for a few months at least back into the growth areas of the market. So if you think about the relative pair that you articulated or asked about, I mean, really, it's pretty stretched. Energy's done very well. Financials had done well up until a few days ago. And of course, tech had started this sell-off at the beginning of this year and has been pretty beaten up and is now starting to outperform. So for the next few months, I would favor that. I think the medium-term trends are back to the cyclicals and values. But for the next few months, I think we'll see some rotation the other way as bond yields come off and we price out some of these rate hikes. I mean, let's face it, Wall Street was falling over itself to sound more hawkish on how many hikes were coming. And I think when you get that kind of one-way narrative, it tells you the price has gone too far and you need a bit of a move the other way. So I think that's what's developing at the moment sector-wise and in terms of bonds.
Chris, it's Karen jumping in. Can I ask you directly around the positioning with Russia-Ukraine, because we're still seeing an escalating oil price. There is a fear that the situation on the ground could drag on much longer than we initially thought. There's a lot of resistance fighting. NATO is coming up with a response at this point, and Russia is not backing down. So how do you position around some of the safe havens around oil and anywhere else in the market where you think that there might be an area where investors can sort of hide out for a number of weeks and months if the situation continues to play out?
Well, it's an extremely good question, and it's an extremely challenging and difficult question as well. And of course, what people do is they buy long out the money call options on some of these energy prices. Ultimately, geopolitics from a human level is tragic, but from a market perspective, it's typically most of the time about the transmission mechanism through energy prices. So what really matters is what happens to these nat gas prices and these oil prices. And of course, we've seen a lot of strength in those in recent trading sessions. And that's the pinch point. But actually, if you look under the surface, the energy transactions were largely excluded from the SWIFT sanctions. The energy continues to flow. Yesterday or the day before, yesterday we were looking at the day before's movement of gas from Russia into Europe. It's still coming. It's flowing as per normal. So, there are some issues about self-sanctioning, but largely for now, energy's been excluded, and that is the key thing to focus on. And I think if it becomes part of the sanction package, then we really do have an energy crisis, and we really do have a problem in terms of Eurozone growth and so on.